Hi everyone. We're very excited for this panel on staking versus lending and its impact on liquidity. Maybe we should start off with some quick introductions for those of us who are not familiar with each other. And I'd like you to focus on who you are, which company you're affiliated with, and you get bonus points if you can say something about your users that may be in Latin America here. So let's start with Mike at the end.
Sure. Hi, everyone. My name is Mike Silagadze. I'm founder and CEO of EtherFi. EtherFi is building a crypto-native neobank. So you can save, invest, and spend all on DeFi rails in a fully self-custodial way. We actually have quite a few users, relatively speaking, in LATAM. Our #1 market is actually Brazil. I guess that'll maybe get me booed here. But we're trying to grow Argentina, too. So yeah, it seems like a really good product market fit in LATAM in general.
Cool. Hey everyone, I'm Artemiy, VP of Institutions at P2P.org. P2P.org is one of the biggest staking and restaking operators in the world, roughly with 10 billions of assets staked and restake. And also we are a yield infrastructure offering DeFi services. Cool.
Hey everyone, I'm Ivan. I'm the tokenomics lead at Parshakov Aragon. We're building infrastructure for any on-chain native organization, and we're helping those organizations turn their token into like an actually productive asset. So I don't think we have specifically like Latin America user base because our users are on-chain native, so like, we don't really care where they are geographically. We don't discriminate in that way.
Hey everybody, so my name is Juan David. I'm the founder of Keyrock. Keyrock is a large financial institution in digital assets. We support a lot of the companies across the industry. We see ourselves as a neo-investment bank instead of a neobank. And more important than that, we are a power user of technology. So typically in the same way that we serve majority of companies in the industry, we're also very often their main user. And so generally, I sit from the other side of the table where we are the ones that stress testing all systems and passing billions of dollars of volume through all kinds of smart contract systems and exchanges. Within the context of LATAM, we are actually one of the largest traders on many of the different currencies versus stablecoins. We're actually, I think, the largest trader of MEX in the world against crypto. And we have a very big operation as well in Brazil.
Okay, great, thanks. Okay, so since the topic of this panel is staking versus lending, I'm curious what are your users, how they decide about whether they want to stake or lend, what type of customers do what, and what other factors maybe affect their decision. And maybe let's start with Artemiy.
Yeah, that's a good question. So on the staking side, so it's pretty obvious. It's already a battle-tested strategy embedded into protocols. So like for most proof-of-stake assets, dozens of percent market shares are staked, and yeah, risks are already like pretty much accepted and understandable. On the lending side, it's I would say it's still a bit new market for institutions and for like we mostly work with institutional clients, with businesses in Latin America in particularly. So like risks are for staking, it's basically slashing potentially, and recently it became more on interface level as well. These risks are being assessed. Oh yeah, on the lending side, it depends on the profile of the particular client, particular institution, and they assess the probability of liquidation, of loss of assets. So and more risk-tolerant clients, they tend into these strategies.
Okay, thanks. And if I could ask a quick follow-up on that. So you're saying the lending is specifically designed for institutions. Could you say a bit, how do you design it for institutions, and how do you differentiate yourself in the market?
Oh, it's a bigger question. We cannot, let's say, look at lending like just straight up. It depends on the asset. For stable coins, lending is basically much more popular because it's basically for stablecoins, lending is staking. So that's why I think it doesn't need to differentiate. So if you want to get yield on your stablecoins, it's mostly lending or some looping strategies on top. And that's the differentiator when it comes to native ETH, native asset. So here it's mostly for native ETH, for example, lending is not that competitive with staking. It's not worth it. So it's mostly LSTs which goes into place. LSTs, LRTs like EtherFi, and also it comes to the risk profile because. If you provide your LST as a collateral, you can borrow once again stables and deploy them into some earning strategies.
Yeah. Okay. Perfect. And then going back on the original question to Mike, what do your users care about in terms of staking versus lending, and what other factors drive them?
Yeah. So I'm going to assume some general knowledge about DeFi here, but maybe the most popular trade in DeFi right now is depositing a liquid staking token. Like, EtherFi has a liquid staking token. So people stake ETH through EtherFi, they deposit it into a protocol like Aave or even other lending markets, and then they can generally borrow ETH at, let's say, 2% or 2.5%, while they're earning 3.5% roughly on their staking with EtherFi. Now, in and of itself, that may say, well, you're only earning 1%. But what people do is they loop that. So they borrow, they stake some more, and they loop that multiple times. And you can get, obviously, very highly variable based on the amount of ETH and demand for borrowing. But you can get your 10 to 15% that way with no liquidation risk because the staking asset is valued at 1-to-1 with ETH. So that's a very common use case, and I would say that in that sense, there's not almost like a trade-off between staking and lending because people can do both. They can borrow against their ETH and earn whether it's stables or looped staking, or they can just stake and chill. I think to the extent that there's any difference, it's people that are just long-term holders of ETH. And they want to hold ETH, and then they want to earn a small yield on it, versus people that are more DeFi native, like funds or whales that are looking to really maximize their returns.
I see. Thanks. And then for you two, your business model is slightly different. Do you see a similar customer decomposition as Mike describes here? Yeah. I
can take that one. So I mean, look, honestly, I think nobody cares really where the yield comes from. I really. When I look at people in our desk, a customer that is been staking $30 million of Ethereum or Solana for a year, maybe as well just take it out and do lending if it thinks that it's going to get a higher yield. So the real question is not like if people want to stake or lend, it's just what yield can they get to what risk-reward ratio. And the whole point here is just that DeFi has become better at understanding risk, but it's still fundamentally intransparent. It's very hard for people to understand the risk that they're taking. And so when you actually put yield as an element without a component of risk, it's just very hard to take that decision. When we come in, it's generally trying to make sure that that is clear. We actually have customers that they would be more comfortable taking counterparty risk to Kirok than to a smart contract. And some customers that would have the actual complete opposite mentality, where they think a centralized institution is something that I don't want to trust, and a staking yield, even maybe lower, actually represents a much lower risk for me. So how do we actually take those two things and we plot, okay, what is the risk reward to each yield component? And if the risk component is the counterparty risk or the independent action that is happening in the smart contract, that's what's gonna determine it. But even in staking, correct, now with the whole restaking mechanisms, the lines are very, very blurry. Like you can think that you're doing something that is very low risk, but in fact, the liquid stake provider is actually restaking your assets to optimize yield or maximize yield because they are trying to compete in that regard, making it very difficult. One of the things that I take at heart is when DeFi was starting, even before money markets really became as big as they are, everybody used to look at yield as Uniswap pools. And today, when we think about a Uniswap pool as something with yield, everybody just thinks it's completely stupid, correct? Because if a Uniswap pool is advertising a yield, everybody knows now that there is a risk associated to the convexity of the curve that is happening in the pool. And now it looks pseudo-evident that you cannot look at the fees in the Uniswap pool as yield, because it has nothing to do. And it's basically the same, kind of like the industry is extremely good at abstracting yield, presenting yield to users, but not talking about risk. And that's really where the institutions differ from retail. Institutions are going to just look at risk-reward ratios, and they don't actually care anything that is under it as long as they can quantify the risk.
Just to double click on that, and then I'll answer the original question. But I think like this abstraction and basically turning everything into a one-dimensional trade-off of like higher yield is one of the big drivers of like a lot of the I would say like the demand side for capital coming in with like T-bill wrappers and like other tokenized RWAs. It's literally like the lender base on chain is less sophisticated at pricing this type of risk. So on chain, I can borrow at a rate that's lower than a sophisticated bank would lend to me, just because like that audience is not really that familiar with the risk profile, and it's become a very one-dimensional market where it's like, okay, like that's the yield. Maybe there is a name of a curator associated with like managing the risk, but like usually people don't really look at like metrics like baked-in leverage, exposure to different underlying assets, et cetera, et cetera. But in our day-to-day, we work a lot more with like what I would call like long-tail assets, which is commonly known as a governance token. And like basically we're trying to help protocols figure out like how can they tap into these more established like stablecoin and like ETH markets to start like feeding real revenue into their systems, because most of the yield associated with governance tokens is typically inflation subsidy, which is by definition non-sustainable. And that's true also for like a lot of the proof of stake networks today as well, right? Like outside of Ethereum and Solana, maybe like everything else is just like inflation rewards. Like there is no actual underlying business logic of network usage brings revenue to stakers, which means like the stakeable asset is actually economically productive. So like, this is sort of like the problems that we're solving for the protocols we work with.
Okay, interesting. And Juan, you just mentioned that people care less about where the yield comes from. How do you see things like this, where most of the yield comes from, for example, from inflation?
To me?
Yeah.
Yeah. So, I mean, I think, if we're looking at yield, and I would say if you kind of like go a step back to understand how the different type of yields are divided, correct? So you would have first what is yield, and then certainty of yield, which is basically in traditional finance the very simple component of variable versus fixed yield. The whole of digital assets runs on variable yield, okay? Which basically you have a number that is advertised, and you might be able to see the number. The number is, let's say, 10%, 20%. But what you don't know is certainty of that number continue to be that same number in the next time slot. And basically you can take that and look at that component for every type of asset. So you have dollarized assets, and you have real-world assets, and you would have, let's say, utility tokens. And in the more certainty you can have the yield is consistent, then you're going to take a different behavior for it. So you would have like these two components. Then in DeFi, at the moment, is basically predominantly about variable yield. But then, because people need to plan ahead and make their treasuries healthy, and the majority of these companies need to start planning for the future, the demand for certainty is actually enormous. And so that's where you would have, on top of all the developments that we had in terms of money markets, you'll have the creation of Pendle, and then that enabling all of these foundations to actually manage their cash flow in a more appropriate way, so they have certainty of yield. What is interesting is that basically also hits into utility tokens, because at the moment that you can actually make a fixed rate of something that is unhealthy, you can actually see how it breaks. So you have a token, that token creates a yield by creating a bunch of inflation. You take that, you put it in the market, and you allow the market to fix it. If people are going to expect a very, very high fee to be able to provide that fixed rate, precisely because this thing is diluting itself. And that's where you start to have like a measurable way to understand if yield is consistent and if the market is willing to pay for that risk in the future. And if it's not, most probably it's just not going to work. And that's a little bit of the problem with yield, that it's just like the components of it have so many more dimensions when it comes down to the future. And so, for example, when we are both a company that helps other companies to get yield, but ourselves, we run a pretty big treasury. We like to borrow from others as well, like very large amounts of capital. But if we would borrow everything at variable rate, it would be a very big problem, because then when the market is actually in a liquidity crunch, all of a sudden something that you thought it was very cheap becomes very expensive because you need to return it. And so if you get yield, but you also get certainty of liquidity, you might be willing to pay a substantially higher amount than otherwise. And so you need to kind of like figure out how to add premiums into certainty to yield to be able to compare them to each other. So very well be a variable rate at 10% might be something that becomes, I don't know, 15% when you have a fixed rate to a month in crypto.
Okay.
I want to build on that because there are like two ways of thinking of like the risk associated with the yield specifically, and like one is fixed versus variable, but like the other one is there are a few protocols that are paying the yield in actual like hard cash or USDC, right? Like DYDX and Maker, for example, like you would be staking a governance asset, but the yield coming in would be at a hard asset that is generated through the functioning of the protocol, and that creates like a pretty robust market dynamics where if the price of the governance asset starts collapsing because you're earning real yield in real dollars, like that just drags the price back up because the implied return that someone expects from this type of asset is, making stuff up, let's say 20%, the price starts to collapse, like the yield is not coming in kind, it's coming in dollars, so that naturally pulls the price back up.
And so, I mean, what happens there, at least the way that we model this internally, is how, if you could actually assign points from 0 to 100 to each asset on how much does it behave like a bond compared to how much does it behave like an equity, you'll be able to do that. So let's say you have the DYDX token, you say it has a yield in USD, you would do a bond stripping of that yield and therefore split it. As soon as you do that, then the question is, would the principal component behave like a bond? Which if it does, then as the price of the asset goes down, the yield is bigger in relative to the premium, therefore it becomes a cheaper bond, and the rational thing would be for it to be bought back. And so the more things behave like a bond, that would happen. But now the reality of it is that, at least what we've seen is that, if you take, for example, the GMX token actually had that exact same mechanics, is that it was behaving like a bond for a very long time, and that was actually great. But then it also, as soon as the protocol started to have like decreasing revenue, and so the yield started to go down, then it went down like an equity, not like a bond, because all of a sudden people started to say, okay, if that decreasing revenue continues, therefore it's not a yield, it's an anticipation of potential future cash flows. And all of a sudden you have these tokens that are behaving like tokens for 2 years, and as soon as the yields are going negative, they switch to become equities, and they get hammered. And so it's actually pretty complex it's very dangerous to model them like bonds, I think, today, because it only works one way. There are bonds when the yield's going up is low, but they as soon as they invert, and they behave like equities. And so that actually makes it very, very hard.
Okay, that's a great conversation. Now I'll try to zoom out a bit again.
Sorry.
No, it's a great rabbit hole to go down on. I'd like to see, in the past year, we've seen huge inflows in terms of both ETFs and digital asset treasuries. And I'm curious how that has changed your business for first Mike and then maybe for Artemiy.
I mean, aside from, I guess there was a moment in time when all the DAT inflows and ETF inflows had a positive impact on ETH price and BTC and kind of lifted the whole market. It hasn't really trickled its way into DeFi yet. I think there's the promise that especially the DATs, digital asset treasury companies, will start deploying a lot of their assets in DeFi. We've seen some do that. So ETHZilla, for example, deployed a bunch into EtherFi. SBET recently announced that they're going to be doing that as well, and a few others. And so the promise is there that you've got tens of billions of dollars of assets that are going to make their way into DeFi. I think that will hopefully invigorate the space and create more either cheaper borrowing, which will lead to more economic activity, or more demand. So I think it's still TBD. That we're still hoping to see more of a positive impact from that.
I see. And just to go further into that, so you described that when that does happen, there will be a huge supply shock, basically. How should demand basically keep up? So what would you see demand shaping like in that case?
Sorry, what would we see demand?
Yeah, so the people that would want to borrow all of those assets, where could they deploy them?
To be very concretely, fairly recently there was a billion or a couple billion that just of ETH went into Aave, and so the cost for borrowing ETH went down from 2.7% and now 2.2%. And so that, for example, among other things, that leveraged ETH trade that I mentioned, the leveraged ETH staking trade, enables that to be more lucrative, and so more people do that, which leads higher yields in ETH, which leads to more capital. So that's an example of very concrete stimulation of demand. DATs, especially ones like ETHZilla, that are maybe more further out on the risk curve, I guess, that's probably fair to say, are willing to do more interesting DeFi things. I mean, I think they're going to be doing, even more exotic trades that, again, ultimately just leads to more demand, for assets in DeFi.
Okay, great, thanks. And how about you, Artemiy? Have you seen any influence on P2P?
Yeah, in a way. So, getting back to your question on how did it affect the business, it didn't affect significantly, really, because we, for years, were focused on this big business players, institutions. So we crafted our offer for them. So I think it was just a battle test for the offer. And what's interesting specifically for DATs is that they care about keeping their assets secure. This is the paramount goal for them, not the yield itself. Just keep them secure, and they are very scrutinous about security. And we, as a company, from inception, specifically, all of our services, and specifically ETH staking, we were very concerned about security. We created distributed key generators, threshold signers, so that basically nobody accessed the full key. It was actually, it elevated our offer on this market, because for less sophisticated players it matters, but not that significantly. And ETFs, so basically ETFs and DATs are different, and they approach yield generation differently. So for ETF, basically it's only staking, and very recently it was in the US it was accepted. And for DATs, I agree with Mike that they are more risk tolerant, and I think at least they proclaim, so they will allocate 20% to DeFi, but I see the initial steps, initial movements, but we're not there yet as well. But things are moving. They are reviewing different strategies, and EtherFi looking being one of them as well.
Okay, perfect. Thank you. Okay, so let me try to squeeze in another question. So you're talking about security. How much does the underlying blockchain matter, and how much of it is basically security, for example, in ensuring that your staking setup is properly managed? Just to double tap on that.
Can you please come again on security?
Could you say a bit about how much the underlying blockchain infrastructure matters for your security, or how much it is, for example, improving your staking setup?
We didn't do basically anything. It was I think it's just maybe initially we thought we over-engineered on security for some reasons, but now it actually became showcasing for the clients, for the market. We didn't change, basically, we didn't change anything. We had some initial setup, we have our roadmap, audits coming up, so it's all, security is always part of the roadmap of in every quarter, so we didn't change, honestly, anything.
I have a bit of a hot take here. I think institutions have provenly don't care about this. I mean, Ethereum Classic was experiencing 51% attacks on like a weekly basis, and the Grayscale fund was still like getting a lot of inflows. That, like, you're purchasing an asset that is being consistently 51% attacked. So I don't think they realize the inherent risk of a secure network, so they don't care about it.
Okay, so wrapping up, I'd like to hear what everyone will be focusing on going forward, and if you have any things that you'd like the audience to take away. We can start with you.
Yeah, I mean, maybe first takeaway to ramp up the topic here. An alternative way to look at how inflows and capital is flowing on chain. You know, for a long time we've discussed the fact that institutions are entering the space, and now the narrative is institutions are here. I have a slightly different view. I think that there are actually 3 steps to this. There is financial institutions, and then there are institutional allocators. And I think both things are very different. I think we're in the time where financial institutions have realized that there is money to be made by themselves entering into this industry. And so all the banks and the service providers are starting to use the technology, but by no means that means that there is yet inflows of capital or appetite to take yield from the institutional allocators. At least we don't see it at the moment in our desk, and we don't have any sign that that is happening at the moment. When we look at the amount of allocation into asset management, which basically is what DeFi is built on. So DeFi is right now a system for on-chain asset management, enabling people to source yield and take exposure to different type of assets. The reality of it is that it's still crypto people trying to compound their revenue and the assets that they have created over the past 10 years. But there is no sign yet that the external institutional allocators are comfortable to take a smart contract risk, and they're not yet comfortable with the technology. Very different than retail. That's where it is. I think the future, and at least what we're going to continue to support, is to work with all of the different actors in the industry to really help them to guide the institutional allocators to enter and work there. We work with majority of the large crypto companies in the world, even with EtherFi, with Aragon, and with many of the great companies in the industry. So hopefully we can build something that really expresses risk in a way that is easy to understand in order to enable allocations into the asset class at scale.
Yeah, for me, as I mentioned, we're focused on more like beyond, like how does the investable universe on-chain looks beyond the blue chip, and we're trying to help projects like turn on-chain assets into an actually investable asset class, because at the moment, outside of venture, there is no one allocating, there is no bid, and we can see that on the price charts, and so we're trying to help teams turn the token that they issued for reasons I'm not gonna dive into, like turn that into an actually investable asset that any like sophisticated allocator would want to purchase and hold.
Yeah, I think from this panel, what I would like to take, my biggest take is that actually, I personally had a perception that we are early in institutional DeFi, rather like, of course, like the institutions they came and we see them allocating capital, but I see potentially at low scale for now, and like after the panel, I see like relatively same understanding of this. And yeah, that's good to understand that we are still early, and yeah, we focus on like DeFi and for institutions, and it seems to be a right track for the next 2 years.
Okay, thanks. Any closing thoughts, Mike?
Yeah, I think, look, crypto has been, and I think to a large extent still is, this self-referential casino, right? And so until it starts branching out into more, actual utility in the real world, I don't think we're going to see, a real institutional bid and more serious players coming into the space, to hold assets more for the long term, rather than just trying to out-gamble the next gambler. And so, for us with EtherFi, like what we're focused on is to create this, broader demand by making crypto more accessible in people's day-to-day lives with this crypto-native neobank offer. And we're starting to see, at this point, probably a trickle of 10 to 15% of our users being more, the Brazilian grandmothers that, are not using the product because it's crypto, aren't even necessarily aware that it's crypto. But they're using it because it actually gives them utility in their day-to-day lives, gives them a way to diversify from the store value, to be able to invest it, to be able to spend it in their real life. And once that demand scales probably 1,000x from where it is today, then I think the gambling will start being more of a rounding error, as it is in the broader economy.
Okay, perfect. Well, we're out of time. Thanks to the panelists and thanks to the audience.
Thank you very much.
Next.